Okay, let's just get right into it. If you look around the market right now, it feels like everyone, and I mean everyone, is captivated by just a handful of giant tech stocks and the whole promise of AI. But is that the only way to play it? Lately, I've been going down a different path, a philosophy that, kind of gets forgotten when there's a gold rush going on. So in this explainer, I really want to lay out the case for value investing and share why I think it's such a powerful strategy, especially when everyone else seems to be chasing the hype.
So, here's how we're going to break it all down. First, we'll talk about the current frenzy, what I'm calling the tech gold rush. Then, we'll get into the absolute core principle of price versus value, and I'll show you the tools investors use to find it. After that, we'll look at the trade-offs between growth and risk, see how you can actually find value inside the tech sector, and then we'll wrap up by talking about how you can start to build your own investing philosophy.
All right, Section 1, the tech gold rush. You see, to really get why I'm choosing to zig while the rest of the market zags, you have to understand the zag. And right now, that is all about tech. I mean, there's just no denying it. If you look at what's driving the market forward, it's sectors like information technology and communication services. The story is just so powerful, right? It's driven by these huge household names, the Magnificent Seven, and this incredible world-changing potential of artificial intelligence. All that attention, all that money, it creates this powerful gravitational pull. And honestly, it's really easy to feel like you're missing out if you're not on that train.
But this is where things started getting really interesting for me. Even inside this so-called elite group, it's not all one big happy family. There's this myth that all these top tech stocks move together, but the reality is totally different. The performance dispersion, which is just the gap between the best and the worst performers in that group, has widened to over 50%. That tells me they're all facing very different challenges. They have different business models. They are not a monolith, and thinking of them that way is a big mistake.
And that just led me to the big question I started asking myself over and over. We know valuations are high. I mean, some would say they're completely stretched. So when I look at one of these high-flying companies, I have to stop and ask, what am I actually getting for my money here? Am I buying a piece of a solid, profitable business for a reasonable price, or am I just buying a ticket for the hype train right as it's hitting its peak speed? And thinking about that is what led me right back to the core idea of value investing.
And that question is the perfect segue into Section 2, and what I believe is the absolute bedrock of this whole philosophy, price versus value. Getting this distinction right, well, it's everything. It's what separates disciplined investing from just pure speculation.
Okay, so what's the difference? It's pretty simple, really. Price is just what you pay. It's set by the mood of the market, by supply and demand, by fear and greed, by you basically bidding against every other buyer out there. Value, on the other hand, is what you actually get. It's the real intrinsic worth of the business. It's rooted in tangible things, like the assets it owns, its power to generate profits, and its potential to grow those profits over time. You could say price is driven by emotion, but value is driven by business fundamentals.
This whole idea is just perfectly captured by Warren Buffett in what I think is the thesis statement for this entire explainer. It's such a simple sentence, but there's a universe of wisdom packed in there. For me, it's a constant reminder to just tune out the noise. So many people get completely obsessed with the price action, the little ticker going up and down, that they forget to ask the most important question. What's the business underneath it all actually worth?
Let me give you a simple analogy. Think about this. Just because something has a low price doesn't make it a good value. You can go buy a cheap Bic pen for, a few cents, but it might leak all over your shirt. Or you could buy a Mont Blanc. Yeah, it costs a lot more up front, but it's a dependable, quality asset that actually holds its value. So the goal for me isn't to find the cheapest stock out there, it's to find the best business I can for the price I'm paying.
Here's another way I really like to frame it. When I buy a stock, I'm buying a small piece of a business. And at its core, a business is just a machine designed to generate cash. So the most critical question you can ask is this. For the price I'm about to pay, how much money does this machine spit out? That spitting out money part, well, that's what we call earnings. And that's the #1 driver of a company's long-term value.
Okay, so if value is all about what a company earns and what it owns, how in the world do we measure it? That brings us to Section 3, the Value Investor's Toolkit. These are the practical metrics, the tools I use to start sniffing out potential value in the market.
So the most fundamental tool, the first one you should always look at, is the price-to-earnings ratio, or PE. It directly answers that question from the last slide. So say a stock is trading at $100 a share, and it earns $10 a share each year. Well, it has a PE of 10.
You're paying $10 for every $1 of its earnings. Now, if another company in the exact same industry is trading at a PE of 30, I have to ask myself, is its business really 3 times better? I mean, an investor who buys a stock without even glancing at the PE ratio has literally no idea what kind of value they're getting for their money.
Next up in the toolkit is the price-to-book ratio. This one compares the stock's market price to its book value, which is basically what all the company's assets are worth on paper if you sold everything off and paid all its debts. It tells me what I'm paying for the company's actual stuff. You know, its factories, its equipment, its inventory. A low ratio, especially if it's under 1, it suggests that I might be paying a fair price or maybe even a discount for the company's actual tangible assets. Now, this is where things get a little more nuanced and really interesting. A company might have a really high PE ratio, right? Which makes it look super expensive. But what if its earnings are growing like a weed? The PEG ratio helps us figure this out. It takes that PE ratio and divides it by the earnings growth rate. So a company with a PE of 30, but it's growing at 30%, has a PEG of 1. Another company with a PE of 15, but it's only growing at 5%, has a PEG of 3. That first company, even with its higher PE, might actually be the better value. I find this metric is absolutely essential for not just writing off fantastic growing businesses as too expensive. So how do we put these ideas together? Well, here's a quick and really powerful screening tool I use as a starting point. It's inspired by the principles of Benjamin Graham and Warren Buffett. I look for companies with a PE ratio under 15 and a price-to-book ratio under 1.5. Then for the final check, I multiply those two numbers together. If the answer is less than 22.5, that tells me the company is a pretty good candidate for being undervalued and it's worth a much closer look. It's not some magic formula, but it's a fantastic first filter to find potential bargains. And this brings us to a really fundamental divide in how people think about investing. In Section 4, we're going to look at growth, risk, and reality. Because this isn't just about spreadsheets and numbers, it's about what you are betting on for the future.
So let's compare 2 classic examples. You've got a growth stock, let's say Apple. It takes its earnings and plows them right back into the business to create new products and just dominate the market. When you buy that, you're betting on its future potential. Then you have a value stock, something like Procter & Gamble. It's a lot more established, it's not growing as fast, so it often pays out its earnings to shareholders in the form of dividends. When you buy that, you're buying its current financial strength, and the risks are totally different too. With the growth stock, the big danger is overpaying for potential that never actually shows up. With a value stock, the risk is falling into a value trap. That's a company that's cheap for a very good reason. Its business is dying.
And this quote just brilliantly captures the nature of risk and why I tend to lean toward a value mindset. You see, when the market is booming, when everything is going up, almost every company looks like a genius. It's easy to get by on hype or by taking on a lot of debt. But when the market turns, when that tide of easy money goes out, well, that's when you see which companies were built on a solid foundation of real profits and strong finances, and which ones were just swimming naked. For me, value investing is all about trying to find the fully clothed swimmers before the tide goes out.
So here's the crucial takeaway. As an investor, I see 2 fundamental risks. The first is obvious. The business I invest in could just completely fail, like the classic case of Enron. But the second risk, and frankly the one that's much more common, is simply overpaying. I could buy a piece of the best, most innovative, most incredible company in the world, but if I pay too high a price for it, I can still lose a ton of money. Value is my defense against that second risk.
So if overpaying for a great company is such a big risk, how do we avoid that in the hottest sector of them all? It's really easy to think of value and tech as total opposites, but you know what? They don't have to be. In Section 5, let's dig into how I've been finding value inside of the tech world.
Okay, this was a huge light bulb moment for me. We all think of AI as this digital, magical thing that lives in the cloud, a business of bits and code. But the reality is, it's a business of atoms. For AI to actually work, you need these massive physical data centers. And those data centers need gigawatts of power from the grid, they need unbelievable amounts of water for cooling, and they need specialized construction just to be built in the first place. That physical reality, that's where a value-minded investor like me can find some really interesting opportunities.
So, I started applying the classic picks and shovels strategy. You know the story. During a gold rush, you can go speculate and try to find a nugget of gold, or you can get rich by selling the picks and shovels to all the thousands of miners. In this AI gold rush, I'm looking for the picks and shovels. These are the companies providing the stuff that's absolutely essential. We're talking thermal management companies like Vertiv and Medine that keep those servers from melting, or networking companies like Arista and Marvell that connect everything, or even the power infrastructure companies like EMCOR that are building out the grid to handle the demand. These are the less sexy but absolutely critical businesses that profit from the boom, often at much more reasonable prices.
So once I've used the fundamentals to figure out what I want to buy, the next big question is when do I buy it? A lot of smart value investors don't just find a great company and buy it at any price, they wait for the right moment. So I like to complement my fundamental research with a look at the technicals. That's analyzing the price charts and market trends to try and find a good entry point. It's a really powerful 1-2 punch.
Let's go back to that Enron example. On paper, their fundamentals, their earnings reports, they looked amazing because they were totally fake. But you know what? You can't lie on a price chart. Any technical analyst at the time would have seen that even as the company was reporting all this great news, the stock price was struggling. It was failing to make new highs, and it was starting to break down. The price action itself was telling a story of weakness that completely contradicted the accounting books. For me, this is exactly why looking at both is so important for managing risk.
And that brings us to our final section, and this one is all about you. After looking at all these tools and ideas, the real goal isn't for you to just copy what I do, but for you to start developing your own approach. This is all about building your personal investing philosophy.
So the very first question you have to ask yourself is this. What is a stock to you? I mean, really, what is it? Do you see yourself as becoming a part owner of a real business, something you want to see succeed for years to come? Or are you just trading a 3-letter ticker symbol, hoping it goes up for a few days so you can sell it to the next person? For me, the answer had to be the first one. And that decision is the foundation of my entire strategy.
You know, investing isn't about finding these perfect magical answers. It's really about making smart trade-offs. Every single decision you make involves balancing risk and reward. Are you someone who's willing to accept higher risk for the shot at higher growth? Or do you prefer a more conservative path, one that focuses on protecting your capital? There is no single right answer here. There's only the answer that's right for your personal goals and, just as importantly, your own temperament.
So after all this, the question is, what is your philosophy? Are you going to be a growth investor, a value investor, maybe a blend of both? Will you rely only on fundamentals, or will you bring in technicals? My own philosophy is to be a growth at a reasonable price investor. I use fundamental analysis to find quality businesses, and then I use technical analysis to help manage my entry points and my risk. But the real goal here is for you to build a consistent approach that you can believe in and stick with, through good times and bad.
Because in the end, the stock market is just a tool. That's all it is. It's a mechanism that connects people with money to businesses that need it to grow. It can be used for crazy speculation, sure, but it can also be used for disciplined, long-term wealth creation. It isn't inherently good or bad. So the only question that really matters is, after learning all this, how will you choose to use it?